Welcome to the fourth quarter 2025 Wespath Investments webinar. My name is Joe Halwax, Senior Managing Director here at Wespath, coming to you from snowy Glenview, Illinois. 2025 was a tale of two halves, where we had a lot of market volatility early in 2025 due to policy uncertainty, most evidenced by Liberation Day, but then a much calmer second half of the year. So today what we intend to do is we're going to talk about the broad markets, we're going to talk about Wespath funds, and then we're going to give you 6 themes for 2026 that we think are most impactful to the markets. I'm joined here by my colleague Karen Manczko. And Karen, before we get started, I do have one question for you. Did you buy your dog Polly a Christmas present?
I did. Polly actually gets really excited, and for those of you that don't know, Polly's my French bulldog that we got in 2020, right before COVID. Polly gets actually more excited to open presents than my 2 daughters, my 13 and my 16-year-old. So we got him a gingerbread man that has a lot of arms and fuzzy things on it and squeaky toys that he absolutely loves.
I figured. Well, good for Polly.
Good for Polly.
So we had another wonderful year in the markets and for investor returns.
Yeah, and I thought a really great spot for us to start this webinar would be to first cover the tailwinds and headwinds that we saw in 2025. And since I'm leading us off today, I'm going to choose which to cover first, and I pick the tailwinds. All the tailwinds kind of really started with that April sell-off. You mentioned Liberation Day, and then kind of swept into the end of the markets and showed some resilience. But as a reminder, 2025 did start off a tad rocky, if we recall. But I'm going to let you cover most of that rockiness in your headwinds. But we did see things improve late in the year with strong earnings surprises that we saw in the third quarter that were primarily led by the tech sector. Also, last year in 2025, we saw a weaker dollar. And what that did was that boosted non-U.S. returns in U.S. dollar terms. And then last, one thing I'll cover before I'll turn it over to you, is that we did see interest rates drift lower overall throughout the year, despite, again, some of that month-to-month volatility, all of which supported equity markets and also credit markets, and particularly those outside of the U.S. So we're going to talk a little bit more about that throughout the webinar. But let me turn it over to you to talk about some headwinds.
Yeah, I think you win. I think there's certainly more tailwinds than headwinds. But as we kind of think about last year, going back to that rocky first quarter, you had in January you had the DeepSeek, it's China's AI model, which kind of brings the overall AI anxiety. Is AI a bubble? Is it overinvested? We spent $400 billion last year and $600 billion this year. So when is AI eventually going to lead to profitability as a headwind? Liberation Day certainly is a headwind, and hopefully we don't have another Liberation Day. We had a government shutdown for, I believe, 43 days, and we could have another one on Jan 30th, so they're negotiating now. And then a kind of a persistent headwind we've had is valuations. In valuations, basically when stocks are expensive relative to history, it can cause more volatility. So Liberation Day probably causes more volatility if PE ratios are at 22 than, say, 12. So that'll be a headwind as we go into 2026 as well.
Yeah, I think as investors, we often forget that 2025 was a pretty volatile year and very much a tale of two halves, like you started the webinar off. Really rocky first half and then ended the second half, or really 3/4 of the year positively, which is always good. But with that in mind, let's talk about broad market performance. And given that I picked first, I will let you pick which market segment you would like to talk about.
Well, I'm going to take equities since they were so strong. I think it's certainly worth noting this is the 3rd straight year of double-digit gains. And as we put a chart up here to show it, if you look to the upper right, and you can really see the MSCI ACWI US and MSCI Emerging Markets both up 31%. So those are really strong numbers for the year, really mimicking the quarter mimics the year in terms of the same themes. International outperforming U.S., large cap in U.S. outperforming the rest of the market again, driven by those AI type names. Some things that are worth mentioning. We had a 19% fall going back to Liberation Day, top to bottom. We recovered that by June, and then had 38 record highs for the S&P 500, and then a new one last week. So we're already starting off the year positive. When you think about international equities, we had MSCI Europe was up 35%. That was the highest return since 2009. Emerging markets up 32% again, highest since 2017. Owing to what you said earlier with some of the tailwinds was the dollar's weakness. So the dollar's weakness was the real driver for international markets. And then also valuations for international markets, we think were one of the big drivers. People rotating out of more expensive U.S. stocks into international. Something we've been saying to clients quite a lot about when would we expect that rotation or maybe even that rotation to continue. We just had 3 out of the last 4 quarters of international outperforming and then 1 full calendar year. So what we anticipate, there's a lot of clients that are talking to the Wespath and Wespath equivalents about am I underinvested in internationals? We would think that tailwind for international is going to continue in 2026. But why don't we, I guess, do you have anything to add to that?
I mean, I definitely agree with you. I think that's going to be the topic of a lot of agendas and client portfolios is, what is the opportunity in international now, given that their valuations have always been attractive relative to U.S., even though international has done well in 2025, their valuations are still pretty attractive for investors. So I definitely think we're going to have a lot more of those conversations with our clients on the opportunities.
All right, so as we think about fixed income, we had another solid year with the Bloomberg Ag up 7%. So can you give us some highlights for that?
It was a really great year for both stocks and bonds, Joe, which, as you mentioned, primarily driven by the global rate cuts that we saw and also resilient credit. So if we want to look at how the markets performed here on the slide, for the fourth quarter, the Bloomberg U.S. Ag returned 1.1%, and the global Ag returned about 20 basis points. So we did see the Bloomberg Ag outperformed the global Ag for the quarter. But if we look at 2025 and the full year, the Bloomberg Ag performed a really solid 7.3%, and the global Ag was up over 8.1%. Again, I mentioned the Fed cut rates 3 times in 2025. And as we enter into 2026, markets do expect the Fed to cut 3 more cuts, 25 basis points cut, that is. But if we think about globally, it's been a real global story in 2025. It's going to remain in 2026. About 30 countries are expected to lower rates in 2026. And with this high number, it's going to be more supportive of bonds and also risk assets.
Yeah, and as we showed on the slide, you can really see both high yield and emerging markets were really the drivers. And when we think about, speaking with our investment team, when does EM tend to do well? EM tends to do well when inflation is stable or cooling, when monetary policy is easing. You mentioned 30 countries cutting. When the currency and governments are stable, which can be challenging in emerging markets. So I think, again, in a similar theme, the same tailwinds that were there in 2025 are also there in 2026.
You're right. I mean, we're talking a lot about emerging market inflation-linked bonds or just emerging market debt. It's great that you mentioned high-yield bonds because high-yield bonds have continued to deliver strong performance and results to the fixed income markets. And as our investors know, our fixed income fund has an overweight to high-yield bonds, which has been a real strong contributor. But we'll talk a little bit more about that. But it's a great segue into talking about our fund performance. So maybe start us off with equities.
I'll start us off with equities, and then you jump in with anything that I miss. Looking at our U.S. equity fund, the absolute returns were strong, as you can see, but we lagged the benchmark by about 6% on the year. The themes for Q4 were the same for the entire year. So focusing on the entire year, underweight to mega cap tech hurt, given the fact that you saw that the Mag 7 and Top 50 continued to outperform the broad benchmark. Seeing some of that at the end of the quarter and this year broaden out a bit, but that was the theme for 2025, and there's a main detractor. 6% allocation to private markets certainly also hurt, as well as some of the individual asset manager performances from stock selection. International side, again, really strong absolute performance at 26%, but we trailed the benchmark by just over 4%. Exclusions, particularly European defense stocks, hurt the portfolio versus the benchmark. Also, the 7% allocation to private markets. Again, private markets can struggle to keep up with public markets, but this has been a particularly bad market for 3 years for private markets. We're expecting a much better 2026 just in terms of expected IPOs and exits. But it has all private markets have been challenged versus public markets. And again, I think that we said the dollar multiple times. The dollar was really the big driver for performance on the international side.
Yeah, just a few comments I'll make. I mean, one, we talked about our ethical exclusions, the defense companies being a detractor. I mean, over the long period, we believe that our ethical exclusions, or the areas in which we don't invest, neither help nor hurt the long-term performance of our funds. But we do realize there's going to be periods where not owning certain segments of the market could be a detractor or also a contributor. And then also I want to talk about active management. I mean, digging more into this, it's the third straight year that active managers have struggled against the benchmark. Primarily, this has been when the market, particularly in the U.S., is controlled by 7 names or 50 names. Most active managers try to diversify outside of those names to maybe find the next Google or NVIDIA. And that diversification alone has been a detractor when those names have been controlling the market. So it has been quite a struggle for active management, but we are seeing more dispersion and opportunities. So 2026 could bring a new year when it comes to active managers within client portfolios.
Yeah, and we have talked a lot about some of the work being done on the funds. And in particular on U.S. equity fund, we did have 3 managers that were hired in December, and we had some managers that have been terminated, but also lowered the mega cap underweight in the portfolio that looks more benchmark neutral. So to get more granular on some of the manager changes, both the new managers and manager exits, we'll certainly be talking to you about upcoming in our quarterly meetings with clients.
Yeah, and we're doing some work also on our international equity fund, recalibrating some of those active sleeves. And again, as Joe mentioned, we'll be sure to provide you those updates in future webinars on the work that's being done. So last but not least, our fixed income fund, when we talk about fund performance, the fixed income fund outperformed its benchmark for the quarter and year to date. For the quarter, it primarily was driven by issue selection from our active managers. This fund is 100% actively managed, and also the fund's overweight to emerging market debt and also high yield. Year to date, or 2025, very similarly, the contributors, emerging market debt, again, that currency moves really helped positively. That issue selection, high yield bonds, and also our dedicated allocation to our internally managed positive social purpose lending program, which provides affordable housing and community development in disadvantaged areas, also was a positive contributor for the 2025 performance of our fixed income fund. Looking at our inflation protection fund, it also outperformed for the quarter and year to date. Both time periods were really benefited by the fund's allocation to emerging market inflation-linked bonds, and again, currency movement. That's kind of been the theme that we've had this webinar is currency.
Yeah, it's a great year for bonds, great year to be globally diversified, reminding us why we hold more than, say, just the Bloomberg Ag in our portfolio. We mentioned at the top, we're going to talk about now as we go into the close here, 6 themes for 2026. Mm-hmm. We'll be recurring these themes and letting you know if they change, but these are the themes the investment teams think is really going to drive markets. Why don't I cover 3? You cover 3, and
sounds good.
We already mentioned AI. I think there's a lot that's been talked about AI, but obviously AI, is AI in a bubble? AI investment. When are we going to see monetization of AI, especially given the concentration of technology in say, in the United States? Second one, geopolitical tensions. Obviously, that's changing, even as we speak. So, there's ones that we know of, and then ones we don't know of. It seems always to be the ones we don't know of that are the most market moving, but we're certainly going to be keeping an eye on further tensions with geopolitics. And then secondly is we've continued to have very easy financial conditions, and we have global deficit spending that continues to be supportive of markets. We expect that to continue, but if for some reason it doesn't, then we would lose that tailwind. So those are 3 that we're looking at.
Yeah, which kind of goes into the next one here on the screen is interest rates and central bank policy. Monetary policy remains in flux. Mentioned that it's expected to have 3 25 basis point cuts in the U.S. and also 30 countries looking at rate cuts as well. So new Fed chair coming in May, which could bring some change as well. but really looking at short-term rates and how those could drift lower and the impact that those could have on both the stock and the bond market. Again, as I mentioned earlier, that market concentration and active versus passive, there still continues to be extreme concentration in the U.S. equity indices, which, again, being diversified outside of those areas was a detractor last year and also years prior. Mega cap tech names remain to be healthy, but we are seeing some momentum in the smaller names, small caps, and which could create some dispersion and be supportive of adding active strategies or of active strategies currently in portfolios. And then the final one, and I know, Joe, you highlighted this earlier, has been the opportunities and challenges as it relates to private markets. Private markets continue to attract capital, but there is that illiquidity trade-off that investors need to be mindful of. Also, recent strength in the public markets that we've seen have added a little bit more of the complexities to these private strategies. But we are adding opportunities at Wespath in terms of the private market offering that we have. We're also looking at our positive social purpose lending program and how we can include the expansion of that and make that available to our investors or potential investors at Wespath.
Yeah, it does feel like this is going to be the year of, say, the broadening of beyond mega cap tech, U.S. to international to privates to something we've been waiting for 3 years, but it feels like this may finally be the year.
Yep.
That is the end of our prepared content, so we really thank everybody for joining today. We want to mention, though, that we're going to be having some future webinar updates about some of the fund option changes that we have, part of our commitment to building clients' custom portfolios, being very client-centric and building portfolios that meet your needs. So we'll be talking to more about changes or additions, I should say, to our fund lineup.
Yeah, we're focused on being good stewards and managing risk carefully within the Wespath portfolios while also staying flexible as the markets change and continue to change.
Yeah, and lastly, we'll be publishing our Q4 and then year-end performance, so check your inboxes. In the meantime, if there's anything that we can help you with, please contact your Wespath representative. Thank you to all of our clients for trusting us with your assets and being good stewards and supporting your missions. Have a wonderful 2026, and go Bears.